what are the hidden costs of home ownership? And is Meta still attractive after its recent run?
This is InvestTalk. Independent thinking, shared success.
Good afternoon, fellow investors, and welcome back to InvestTalk. This is our Wednesday, June 12th, 2024 edition. I'm Justin Klein, and I'm excited to have Luke Guerrero back with me today, fresh off our wealth webinar yesterday, as well as today being Fed Day. So welcome back. Are you still juiced after the last 24 hours?
Oh, I'm always juiced, regardless of it being Fed Day. I think the wealth webinar revitalized me.
There we go. Hopefully revitalize a lot of our listeners as well. And our job here is to revitalize the current listeners, those that are here for this hour. We're going to answer your finance and investment questions, hopefully a lot of live calls. So we encourage you to reach out if you are listening live. If you're not, no big deal. You can leave your message on our listener line at 888-99-CHART. Same number, whether you're live or after hours. Now, today's goal here is to help you take that next step in your investment journey by giving you perspective as well as data that can help you make good decisions consistently with your money. And let me go back to that wealth webinar because I think it was a really important one for everyone to watch. You can go find it over on our YouTube channel. It is there. So we did a deep dive in the challenge of finding good investment opportunities in markets and why dividends, while important, are not the only factor when you're trying to find good investments. And we talked about the perils of chasing dividends. So we looked at quantitative factors as well as qualitative factors that go into finding great opportunities. So I encourage everyone to head over to our YouTube channel and check out that recorded webinar. Now, in just a bit, we're going to talk about the market performance and run down some show topics. But as usual, we are going to tackle this caller question now.
Hi, this is Bill from San Diego. I have a question. I use VIX to monitor volatility. Is there a better strategy? Thank you. Have a nice day.
Well, I wouldn't even call it strategy, right? You're just looking at a gauge of basically the put-call ratio. And as of late, because there's so many vol selling funds, selling short-dated vol on the major indexes, it's kind of dampened volatility overall. So in today's new options world, with so much notional value being traded every single day on these short-dated options, it kind of skews the vol picture in my mind. And I think that's why you continue to see the VIX hanging around the low teens. It's at 12 today, which historically is near all-time lows. And for everyone else out there, when you see the VIX down, that's good for risk assets. And, the vol selling habit, shall we say, of the investing public has certainly helped buoy markets. And so I'm not sure it has much predictive power at this point. What are your thoughts on the current state of the vol market, Luke?
Yeah, I think that's pretty accurate. Like you said, it just looks at options implied volatility. And so, if you want to have a similar strategy, people can look at the NASDAQ volatility index. You can look at the Dow Jones volatility index, but they're all essentially doing the same thing. And so I tend to agree with you that it may not be the best indicator of volatility for many reasons as it was historically. And I mean, that's evidence has shown it's kind of just been sitting in the 12 to 18 range for quite some time. So frankly, I don't see much better ways to measure it from a market-wide perspective. It's probably still the best way to do it, but just keep in mind that the explanatory power might not be there as it once was.
There we go. Now, we have a lot of ground to cover the next 45 minutes or so, and our main focus point is about the hidden costs of home buying. So many people focus on that monthly payment, that mortgage payment, but there are other aspects that go into owning a home. If you are a homeowner, you probably know this. You're talking about insurance and taxes and maintenance, utilities, etc. And a lot of people overlook that when they're trying to buy a home and calculating that into the total cost. And remember, most of those costs you don't get back. Just like a lot of people say, oh, you rent and you're not going to get that money back. Well, the total cost of owning a home, the majority of that is approaching the majority of that typically you don't get back either. So, and those hidden costs are rising. And we're going to talk about those numbers. On average, it's about $1,500 per month. That's on average. Now, it's going to vary, and we'll talk about those variables when we touch on that main focus point. We also have some other topics. One is the report from the IEA, International Energy Agency, on where investment in the energy space is headed globally and what that might mean for prices. And then we also are going to touch on a few other topics. One is about Whole Foods and Trader Joe's. And there's some interesting lessons that can be made, taken from that, the rise of both of those names. And then lastly, if we have time, we're going to touch on what a city in the north of the border have been doing about all those empty office buildings that are sitting there vacant. Okay, so that's what's on the docket for us. We also will hit voice bank questions. One is about iron butterfly options, as well as big lots, BIG. And of course, your live questions are most important. We will get some questions submitted via the comment section of our YouTube channel as well. But we encourage your live calls. We're heading to a short break. And on the other side, we'll tackle today's market activity and take your questions on the InvestTalk voice bank at 888-99-CHART.
The stock market is constantly changing, and serious investors want a way to get the latest news and unbiased investment insights. Welcome to the InvestTalk podcast.
Do you want to be a part of the conversation? Don't forget to comment below so we can answer your questions on the next InvestTalk podcast.
Now, let's take a look at the market today, Luke. It was Fed Day, and we started off the day with good inflation data, and that certainly helped markets overall. Small caps were up the most, about 1.5% there, but there were other parts of the market that did well also. What was your main takeaway from the inflation data as well as the Fed? Not change, right? They didn't do anything, but obviously they spoke about what they expect for policy going forward.
Well, yeah, there actually was one change in terms of the dot plot, right? There was only one cut now anticipated for 2024, whereas it was 3 back in March. The market was anticipating maybe 6, which was always, as we have said, over the top. But at least the dot plot showed 3 back in March. Now it's showing 1. Powell also had some comments that showed really more confidence in the disinflation narrative, which markets liked as well. But I think a lot of the tailwind came from, like you mentioned, CPI coming in lower, less hot, cooler, if you will, than expected. And that's why some big tech names did well. A lot of AI names did well. Also, small caps, like you said, did very well today. The Dow was down on the day, down 9 basis points. But other than that, most major indices were pretty up.
Yeah, what's interesting about the markets is that they still don't believe the Fed. They didn't believe the Fed on 3 cuts going into the year. They were pricing in 6. They don't believe them on 1 either. Now, there's still about a 2/3 chance that the market will get at least 2 rate cuts by the end of the year. What's interesting is there are 4 meetings left in the year. And there's about a 1.2% chance we'll get a cut in every single meeting, or at least 4 cuts by then. So, or by the end of the year. So that's what's interesting, is that the market is fading just 1 rate cut by year end. And certainly the weaker inflation data fueled that narrative once again. But that really drove the market up. You saw small caps once again. Remember, when rates go down, small caps are most sensitive to that. And you certainly saw those rebound nicely. You saw the dollar that was down as well. So that did help some of the commodity names. Gold was up as well, but it did fade throughout the day because the dollar did get a bit stronger throughout the day, just as the equity markets faded a bit throughout the day. But overall, a very solid reaction to the inflation data as well as the Fed numbers. And then next week we go into OPEX week, so that should be somewhat a volatile week as well. That's quarterly OpX. So that was the market today, and we'll see what type of follow through we get in the coming days, because typically there takes a few days for these type of major news events to settle out in markets. So we'll know a lot more, I think, by the end of the week. Now, I hope you've been telling your friends about the InvestTalk audio podcast and the fact that it is available on YouTube in video form. You can see the charts that Luke and I look at each and every day, so that you can get some context to the things that we are saying on air. Now, we get comments in the comment section, or questions in the comment section on the YouTube channel as well. So let's answer one of those now. Forrest Becker says, my stock screener has PE, revenue growth, return on assets, return on equity, price to sales, price to book, and beta. I'm able to find some good companies, but also some not so good ones with this screener. Any recommendations to add or delete criteria from my screener? I also tend to look at mid to large cap stocks with low or no dividends. Thank you. Anything you would omit, from that list, Luke, or add?
I think there's some redundancy. You have a couple profitability metrics in there, ROA, ROE. They're probably going to give you the same basket of securities, generally speaking. I think the fact that the commenter is looking at revenue growth is good rather than just looking at revenue. I'd maybe add looking at growth and cash flow from operations, right? If you get more cash flow, that's good for a company. Cash flow is the lifeblood of a company. Maybe take a look at something that's more balance sheet related, like interest coverage ratio, to look at your leverage, or debt to equity, something to filter out some of those securities that have too high debt burdens. What about you?
Yeah, I echo all of that for this commenter as well as our listeners. I would once again head over to our YouTube channel, check out yesterday's wealth webinar. We go over a lot of these metrics that we tend to look at and that we think are important, and what number to look for. Overarching though, what I would say is look at these on a sector basis, because you're going to have very different ROEs, ROAs, price sales ratios, et cetera, across different sectors. So make sure you're setting the criteria of what you want to see based on more like the industry average versus some raw number. Okay. And then beta, the last one was beta. That's just a measure of volatility to the overall market. That goes back to your risk. Should you want to take more risk or less risk? You said you want more mid caps. Those are going to skew towards higher beta, and you have to be comfortable with that. So thanks for the comments, and head over to the wealth webinar from yesterday. Now, if we move fast, we can squeeze in one more caller question.
I was wondering if you could explain the difference between ordinary and qualified dividends, and how I can tell which kind the company pays out. Thank you.
I believe those are the same, right? Ordinary dividends, they're taxed at your ordinary income tax rate, I believe, right? Yeah, there we go. And qualified are taxed at lower rates, 15 to 20%. If you're very low income, 0%. But ordinary dividends, those are going to be taxed at your ordinary income tax rate. Typically, you're looking at two types of companies pay ordinary dividends, and that would be REITs, and technically REITs aren't a company; that's its own entity structure. And then limited partnerships, once a company, that is those tend to come with K1s, and those also pay ordinary dividends.
I'll also point out passive foreign investment companies and also securities that are registered in countries where we do not have a tax treaty. Are the other generally two sources. Yeah.
So if they are a corporation, they're domiciled here in the United States, typically you're going to be getting qualified dividends on those names. Thanks for the call. Now we're heading into a short break. Still to come, more answers to caller questions and our focus point. This is InvestTalk. Give us a call right now and talk to us live at 888-99-CHART.
Hey InvestTalk community, Justin and Luke here. We are so thankful you've been with us through this investing journey, but we are just getting started.
That's right, Justin. We're excited to bring you more exclusive content. Think more of the critical analysis and expert advice that you love.
You'll get insights into smart investing strategies to help you navigate these turbulent times.
Don't miss our live Q&A sessions every weekday at 4 p.m. Pacific, where we answer your burning investment questions.
Just call our InvestTalk listener line at 888-99-CHART, leave your question, and we'll tackle them on the next show. Who knows? Your question could be the next big topic we explore together.
So stay tuned and call 888-99-CHART to leave your comments. We're here to make investing accessible, understandable, and hopefully even a little more fun.
Chart your path to financial freedom here with the InvestTalk podcast.
Now, our main focus point today is about the hidden costs of home ownership. And a lot of people talk about the mortgage when thinking about buying a home, but the hidden costs, such as property taxes, homeowners insurance, electricity, internet, cable bills, etc., they can add up. And as of, was it last year? The average monthly cost was $1,510 per month, according to bankrate.com. Okay. And that includes an estimate of about 2% of the home's value on maintenance. Now, I will caveat this, Luke. I think 2% is a bit high. I usually use 1%. Now, that depends on the life of the home, right? If it's a brand new home, it's probably closer to 0.5%. If it's an old home, 2% might be appropriate. Maybe 3% might be appropriate. But either way, the costs, these hidden costs, are about 26% higher than they were 4 years ago. So that's pretty significant, about 5% growth each year in the cost of maintaining this, maintaining a home and having a home. And these are expenses you never get back. So how do you think the average homeowner should think about these costs in context to the total cost of homeownership?
Yeah, well, first they should think about them. A lot of people don't. You mentioned maybe closer to 1%. I would argue that it really depends regionally, right? If you live in a state where there tends to be colder winters, you can expect your pipes to burst probably once every 5 years.
Yeah.
When I was going to college back in upstate New York, I was in 2 different apartments where the pipes burst. And they were old apartments, but certainly, like you said, that does play a factor in how old the house is. I will give you anecdotally, I have a friend who, if he's listening, him and his wife, they know who this is, recently bought a home.
I know who you're talking about.
You know who I'm talking about too. I was telling them how expensive it can be beyond the sticker price, if you will. And then within the first month of them living there, they had a rat issue, they had a plumbing issue. A lot of homeowners, when I was a kid, my parents had to deal with maybe 2 fixes to the AC system in the 18 years that I lived in that home. So there's a lot of issues that people don't think about. And that's before we get into the fact that you're paying interest in order to own this house, and there's an opportunity cost there. So, it's much like you should have a holistic view of your portfolio and not think about how the individual pieces work alone. You need to think about how everything works in tandem. And there are a lot of costs that certainly, according to this, are only increasing, like you said, rising by 26% since 2020, that people do have to keep in mind, especially in a time where a lot of people bought homes thinking within the next couple months, rates are going to drop. I'll be able to refinance. I'll get a lower rate. And now there's a lot of people that are locked into something that they really aren't able to afford. And then should this happen where your water table goes under, or your pipes burst, like I mentioned, you can find yourself in a very unfortunate situation financially. So going into it, know what you own, know what the costs of ownership are.
Yeah, and post-financial crisis, there's a lack of building, because those home builders were scarred, and so they tended to only build towards demand. If there was demand, they would build it, and so that just generally created a low level of new homes coming on market. And according to an American Community Survey by the U.S. Census Bureau, the median age of an owner-occupied home in the United States is 40 years old. 40. And around that time, you need a new roof, you may need new HVAC systems, et cetera. A roof typically lasts 30 years. Siding usually lasts 30 to 40 years. So it's definitely something the age of the home certainly matters. And one mistake a lot of people make is they put all of their money towards the down payment. They don't have anything left over for maintenance, furniture, et cetera. So make sure you don't do that. In 2023, 46% of homeowners use cash from savings to cover home improvement projects. 20% use credit cards. FYI, don't do that unless it's an emergency. 7% refinance an existing loan, and 5% use the home equity line of credit. And what's interesting is because the housing market is very competitive, especially as of late, many people are waiving home inspections, which I vehemently advise against. Okay, in April, around 19% of buyers, 1 in 5, waived the home inspection, according to the NAR data. And now that is down from 22% the prior month and 21% a year earlier. So it is headed lower, but still, don't buy a home without doing the proper proper inspection, because you never know what you're going to find from problems with the foundation. You know, maybe it needs a new roof, maybe it needs a new air conditioner or water heater, etc. For somebody who recently bought a home, had to replace the water heater just a few months ago. So I know this very well. So I always think this is an important topic because too many people simplify the buy versus rent decision to what's cost of rent versus what is my mortgage. Well, there are a lot of other costs, and many of those costs you do not get back.
I would also add that it's very important now more than ever, especially on the back of that settlement with the NAR, where people are going to try and close more quickly in order to get ahead, that you do your due diligence, especially because you may not have somebody looking out for you.
There you go. Now, in the next Invest Talk, we'll look into this story: how to make sure your personalized portfolio doesn't backfire. A total wealth approach can lead to better outcomes. We'll dig into that story tomorrow, but for now, I'm Justin Klein here with Luke Guerrero, and we are ready to take your calls live at 888-99-CHART.
Everybody wants a secure financial future, but getting there takes strategy, discipline, and the right information. Welcome to the InvestTalk podcast.
Hi, I was wondering if you guys could take a look at Big Lots, ticker BIG. This stock has just been beaten up, and I'm wondering if you think there's any chance of it with a turnaround play. It seems like if so, it would be horribly mispriced. But again, if it's ultimately going to go bankrupt, then it might reflect the correct price. Anyway, if you just take a look at it for me, please, and give me your opinion, I really appreciate it. Love the show. Thanks. Bye.
All right, looking at Big Lots, and this is a name that was very profitable pre-pandemic, and even during the pandemic, they did very, very well. However, they had a balance sheet that was very levered, and they had customers in the lower rung of the income ladder that suddenly were not getting subsidies, and they were stuffed with too much inventory, and they've just fallen under the weight of all that inventory, all that debt, and they look like they're on the brink of bankruptcy. So, it's a name that, historically had a great business and it did very well, but you can see how just one bad move by taking on too much debt, too much inventory can really literally tank an entire company and force it into bankruptcy. And that looks like where this is headed. What are your thoughts, Luke?
Yeah, it's dead. I wouldn't touch it with a 10-foot pole. It's they got too much debt. They have very negative cash flow. Their profitability's fallen off a cliff. I would not touch it.
Their times interest earned is negative 8.5.
And even with that, the market still thinks it's got ways to go because the short interest is about 24%.
Yeah, well, it's the bet that equity trading at $2.38 today is worth zero. Yeah. So, whether it goes from 100 to zero or $2 to zero, it's still 100% return on your money, right? So that's what those short sellers are betting on. But maybe some company comes in and swoops them up and wants to assume their debt, but that's probably very unlikely. Now let's touch a bit on the energy industry, Luke. There was a recent report from the International Energy Agency, and it looked at the shift to renewable energy. And what they see is that roughly 55% of the global energy investment went to fossil fuels in 2015, but that's expected to fall to only 36% this year. And they expect 2/3 of total energy investment so $2 trillion of the $3 trillion this year, to go towards clean energy. Now, historically, the industry is a bit more bullish on the deployment of green energy than what comes to fruition. And they expect global spending on renewables to hit $770 billion this year, mainly wind and solar. And that's compared to only $80 billion going towards coal-fired power plants and gas-fired power plants, a ratio that's almost 10 to 1. And it was 2 to 1 back in 2015. So that is skewed dramatically towards renewables. But that differs depending on if you're talking about developed economies and developing economies. And the big question is, will those developing economies be able to secure the proper investments and resources to make the proper investments? What did you get from this report that stood out the most?
Oh, well, certainly something that would come as a surprise to probably nobody who's been paying attention is that China leads in its clean energy investment. They have for quite some time, as well as leading in the technology that has been helping countries convert. I think that's probably where the Obama administration, actually going all the way back almost a decade, tried to use government subsidies to get after China's edge in solar technology. I think that the issue has always been, maybe not even from a complexity standpoint, but certainly from a moral one as well. You have all these countries that are developed nations who were able to get there through the Industrial Revolution, through burning of fossil fuels, now going to a country of people on bicycles saying you can't do this, right? Yeah. And so I think generally speaking, if you're going to try and reach climate targets, there's going to have to be some pretty massive subsidies from developed nations to help those developing nations afford the technologies. But I also think that competition from the United States and China and all these other countries that want to get into the renewable energy creation business will certainly help drive prices down a little bit. And as we expand beyond technologies that are requiring very expensive to get metals, right? When we get away from lithium batteries, more towards sodium batteries and the like. So I think different supply chain. I think as always, innovation tends to drive prices down and competition is good. And so hopefully, in the next 5 to 10 years, the cost for these developing nations goes down. But certainly I don't see them being able to convert in the way developed ones are without some sort of subsidy to help them along the way.
And you're seeing that now. The IEA says that the investment in green energy has to double by 2030 to hit the net zero targets of 2050. Yet this year, there's about $770 billion that's expected to be spent on renewable power. That's only up 5% from last year. Last year, it grew 22%. So that growth rate is slowing dramatically. Probably a big part of that is the higher cost of capital that these projects are facing. Because remember, these are big upfront costs, just not a lot of ongoing costs like you would with traditional gas-fired or coal-fired power plant. And solar leads the way, okay? But this year, renewable capacity is only supposed to grow 20% versus what it grew 60% last year. And, the nuclear side, I think, is the most interesting and has the most growth potential, at least year over year. Investment in nuclear power is also on the rise and expected to hit roughly $80 billion this year, almost double the level from 2018. And a big area of spending is going to be cables and pylons needed to move the electricity around. That's supposed to hit $400 billion this year. So it's not just the actual wind turbines or the solar cells or even the nuclear power, but it's the moving all of that power around that's creating a lot of spending as well. And so I think that's an underappreciated part of this story, and we'll continue to build and build. And we're actually looking at more names like that. A lot of those names aren't overvalued. They have good, consistent businesses, but they are finding great growth. So very interesting report and a lot to take away that you can take back with you to make better investment decisions. Now, speaking of uranium, we are going to pivot back to our question via the YouTube channel. And this is from John1174. It says, what are your thoughts on ETF URA? I bought it around $23. Should I sell some or hold on to it? So now it is, so this is URA. This is the Global X Uranium ETF. And as we just spoke about, nuclear power is getting more attention, and I think it will continue to do so, especially when those that are involved in the energy infrastructure realize that the supply chains needed to build out this level of capacity is just not there, right? As well as the fact that most of renewable power is not baseload. It's intermittent, depending on the weather, whereas nuclear is baseload. And so I think it's just a matter of building the proper infrastructure to build small modular reactors and figure out the process. And once that happens, I think you're going to see these rolled out in a big, big way. And URA is simply an ETF in the uranium space, and it has been an uptrend for, let's see, a while now. When did it break out? Just going to pull out to a weekly chart. I mean, this broke out really right after the pandemic. It was at new highs by August of 2020, and it's been in an uptrend ever since. Did go through a consolidation period in 2022, just like the whole market did, but continues to be on a nice uptrend. I have no problem with this if you just want broad-based exposure to the uranium space. What are your thoughts, Luke?
Yeah, I agree. I think the only concern I have about nuclear power generally is that when there are issues at reactors, they tend to be very visible. And so I feel as though we are far enough removed from the last issue at any nuclear reactor that the stigma is starting to disappear, which is good because nuclear energy is generally safe. But my only concern is that should something happen, that could dampen the demand for it. But regardless, I think that nuclear energy in the long run, it's important to note that long run, I'll say it one more time, is a critical part of a renewable future.
Yeah, and you're right. You know, any major scare or minor scare certainly brings back memories of what's the one in Ukraine?
Chernobyl, or even 3 Mile Island in New York. Anything like that.
But I mean, that was, nobody was hurt with that, right? It was just a release, and you don't. It's not something that a lot of people look at. For example, nuclear waste. They say, "Well, it's nuclear waste." Well, it doesn't produce much, and 0 people have ever been hurt from nuclear waste, right? So there's a lot of bad stigma there that, like you said, is working its way off over time, and I think it's just becoming more and more accepted that this has to be part of it. We can't just rely on wind and solar and think that's going to solve all our problems. It won't, and so. This is a good way to gain exposure if you don't want to do the deeper research to find the best names within the industry. Now, we're moving fast through the second quarter, actually the first half of the year. We only have a couple weeks left until we're into the back half of the year. This is a good time to check in with your strategy, check in with your goals, and figure out whether you should rebalance your portfolio, shift up your strategy, etc. And if you need help understanding whether your portfolio fits these times, the current market trends, etc., I encourage you to reach out to our company, KPP Financial, where we practice parallel investing, which means we invest right alongside our clients, and we have the same philosophy, on and off air, which is independent thinking and shared success. So we're going to bring you along with our success, and with that, we encourage you to take advantage of our free portfolio review assessment via telephone or GoToMeeting. Just head over to investtalk.com, click on the portfolio review button on the top right-hand part of the screen, and fill out the form there, and we will get back to you to set up a call. Now, this is InvestTalk. More answers to your finance and investment questions are coming up, so hang on.
So this is Pete from Staten Island, New York. Long-time listener. I'm 23 years old. I actually started listening to you guys when I was delivering pizzas. I was saving up a little bit of money and listening to you guys, learning about the financial world as a pizza delivery boy. I've now graduated and I've grown up, and I have a question about Con Edison. I think the ticker is ED. I currently work for them, and they have a stock option plan where they match 1 share for every 9 shares I buy, and I think they match the dividend percentage as well. I was a little curious about what you guys thought of the company, thought about the financials, and really how conservatively or aggressively I should be investing in this program. and really just overall the financial of the company and what you guys thought. Thanks, and I look forward to hearing the answer on the show.
All right, looking at Con Edison, and this is the Consolidated Edison of New York. And they also serve parts of New Jersey, southeastern New York, etc. And, you know, this is a fine utility company. I have no issue with it. It sounds like they're matching to some degree. I forget the match. Did you hear what match it was, Luke?
I believe what he said was for every 9 shares he purchases, they give 1 share.
Okay. So about 12.5%. Would that be 11%?
Yeah, about 12%.
The math there. Yeah, 12% match there. That's pretty nice. Now you don't want to go overboard. We typically for your own company you work for, you don't want to tie yourself too much to that name because your income as well as your investments are suddenly tied to the same company, and then you could have an Enron type situation and your entire nest egg, including your income, it blows up overnight. Not to say that's going to happen with Consolidated Edison, but you never know. So I would say about 10% of your total net worth, probably want to limit that to your exposure to Edison. Now, one issue I have with this utility itself is, it's in the Northeast. People are moving out of the New York and New Jersey area into the middle of the country, and there's not a lot of demand growth there versus some other utilities. So if I was going to go buy a utility, this would probably be lower on the list. But you're getting the match. It's a fine utility overall from a profitability perspective. Any red flags you are seeing on your end, Luke?
Well, I'm not seeing any red flags, but I think generally one of the benefits of the employee stock options plan is growth, right? Mm-hmm. And so the reason why you defer some of your pay, or in this case, I imagine what would be going on here is you defer some of your pay and purchase stock options, and you get a match, is that you're banking on the growth of the company's equity value. Mm-hmm. And utilities specifically don't really see outsized growth. So maybe you want to take a little bit and invest in their plan because you're getting that match that's around 11%, which is great. But just keep in mind that you also could be paying an opportunity cost and investing in other places that traditionally have better growth. So it's like you said, take some of the match, but don't go overboard.
Exactly. Yeah, you're getting that 12% guaranteed, that match, which is great. But remember, that's only 1 year as opposed to over many years, utilities, because they tend to be underperformers, you're probably going to do better over the long term allocating elsewhere. So, yeah, don't go overboard. Now, this is InvestTalk. I'm Justin Klein, here today with Luke Guerrero, and we have one goal each and every weekday, and that's help you achieve your own version of financial freedom. And our work continues after this final break, so get your questions in now at 888-99-CHART.
You are invited to be a part of our learning experience. Simply use the InvestTalk voice bank to record your finance and investment questions anytime, 24/7 at 888-99-CHART.
Love today's InvestTalk episode? We want to hear from you. Drop your investing questions in the comments below, and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by Luke and I. Dive into the comments now and become a part of our next conversation.
This is Yannick from Denmark. I have a question regarding Meta, META is the ticker symbol, formerly known as Facebook. I have this stock on retirement account that I manage for my girlfriend. Bought it last year. I have at least 30, 40 years span of time. I know that it's not one of your favorite companies, but I'd like to hear your opinion. Thank you.
All right, Meta Platforms. This is the name that had a really rough 2022, especially because they were leaning into the metaverse dramatically, and it fell from $380 per share to a low of $88 per share. So down pretty dramatically. And then they pivoted, and they focused less on the metaverse and more on the things that actually make them money, like Facebook as well as Instagram. And obviously they have Oculus, which I think, didn't they rename Oculus?
Quest.
Quest, yeah, I liked Oculus better, but
I did too.
nonetheless, it's rallied. It's at $508 per share. It did peak recently around 530, and the technicals are weakening just a bit. I would say it's a bit overvalued. It's supposed to earn about $23 per share this year, so low 20s multiple. It's going to be very tied to the advertising industry and advertising cycle, and thus the economy. But also the whims of where management deploys their capital. This sounds like this caller's up a bit. Do you think this is the time to trim, or you think it just hold with a stop?
Yeah, I would probably hold on for now. I think it's trading at a relatively high multiple at that 23 times price to earnings, but that's pretty much where it's been trading over the past 5 years. I think they did a good job in abandoning the metaverse, though. It is hilarious that they're still called meta platforms.
Yeah.
I think my issue with Meta relative to some of the other names that have ridden this AI wave is I don't really see their place in it, right? Like I see what Microsoft is doing with their partnership with OpenAI and integrating that into their cloud systems. I see what Apple is doing with their new Apple Intelligence and integrating that into their smartphones. I see what NVIDIA is doing in terms of the hardware being an essential part of that supply chain and creating those models. I don't really see what Meta's doing. And so I think of some of those bigger names, I'm probably least likely to look at this and pay more for this. But I do think it's not crazily overvalued. I certainly wouldn't buy any more. But if you do have opportunities to trim a little bit and reallocate some of that capital into names that haven't had a significant run up in the past year, up 87%, that might be a good idea.
Yeah, I think Meta has one mainstay, and that's Instagram. I think that the Facebook platform, that's been dying and losing user engagement for a long time, but Instagram remains a behemoth, and frankly, it's probably worth far more than Facebook is today. And Oculus, that's good. It's I think it's a solid business, but it's not. It's no more than a small percentage of their total value of this company. So it's really about Instagram, and you're tying yourself to the popularity of Instagram. We obviously have TikTok that's growing in popularity. There's some issues with regulations there, and certainly TikTok could continue to take market share from Instagram, although that's at a pretty low level. So I think this is the time to maybe rebalance it slightly, but I wouldn't wholesale sell it because, like Luke said, it's definitely not overvalued. Now, Luke, I don't know if we have time to get to our last one. Maybe we'll tease it for a future show, and it's really about your two favorite grocery stores, Whole Foods and Trader Joe's. And I think there's some great lessons that come out of here from the story of the two, very interesting, small-time grocery stores that I think we're going to have to get into in a future show because we just don't have time. But I'm excited to talk about that coming up here on a show with you.
I will say, Costco, in case you're listening, you are actually my favorite grocery store. And Trader Joe's is a close second. And Whole Foods only when I need something very quickly, as I told you before the show. But that'll be an interesting topic, especially just talking about how Whole Foods has transformed itself over the years.
Yeah, and we'll have to cover the ears of Costco when we talk about it so that they don't get offended by your glowing review of Trader Joe's. All right, well, that about does it for this episode of InvestTalk. I'm Justin Klein with Luke Guerrero, and we appreciate you tuning in, and we encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. Be sure to rate and review on iTunes as well, and head over to YouTube and search InvestTalk with 2 T's and subscribe to our channel. This is InvestTalk. Independent thinking, shared success. Good night.
Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.